Hey, what's up guys? John here. The job numbers came out today.
The eagerly awaited September jobs report out this morning showing 336,000 jobs were added in September.
The unemployment rate in the U.S. stands at 3.8%. That remains unchanged from the month of August.
This is good news for the economy right now. The fact that we can deliver over 400,000 jobs, if you include revisions, without earnings pressure is good news. It is, secondly, bad news for markets and for the Fed. The Fed is not going to welcome this report. Over the long term, this may end up being bad news for the economy as well.
And it's signaling that we're going to be going much higher, and the Fed's going to continue to increase interest rates in the short term and keep them there for longer than many people are anticipating. In fact, I think we're going to see 10% mortgage rates. We're going to see a bloodbath in the real estate market, especially commercial real estate. Banks are going to be in very, very big trouble, and we're going to see a complete overhaul of the labor market in America. And I'm going to break this down for you clearly with verifiable facts. Please hit the like button. YouTube will share this content to educate other people about what's really going on. And if you want to fix your credit, you want to position yourself for the greatest wealth transfer of all time. We started this in 2020. It's ramping up now. 2024 and 2025, it's likely going to be a bloodbath in this economy. And that's when the great investing opportunities are presented. So if you're looking to fix your credit, to position yourself so you can get financing to invest and really level up when most of the world is going to be in trouble, go to GreatCreditFast.com if you have credit issues. We'd love to help you. If you have late payments, medical bills, charge-offs, foreclosures, bankruptcies, repossessions, any negative item, don't ignore it. Book a free strategy session below. We'll tell you exactly how long we think it'll take to fix your credit, what the process will likely look like, answer any questions that you may have. Go to GreatCreditFast.com. Click the link below. Take a look at this. Jobs gain surge, right? So employers added 336,000 jobs last month, sharply more than the 170,000 that they predicted. Twice. Jobs numbers 336,000, they were anticipating 170,000. And the Fed's job, what they say their job is to increase interest rates to try to cool the labor market to combat inflation. Well, that's not going so well. So what are they going to do? They're going to continue to increase interest rates. That's what it looks like they're going to do. Look at this. The U.S. economy added 336,000 jobs alone. But what many headlines don't mention is the revisions in August. Revisions show 227,000 jobs being added in August, above the previous expected 187,000. That's 40,000 more jobs on top of September's numbers. How can the Fed pivot? They're not going to pivot. Many people thought they were going to pivot in January. How is that working out? Right? Many mortgage lenders were saying, date the rate, buy the home. You could refinance later. Well, that I believe is going to be very, very risky advice, and you should never gamble your future, your livelihood on an adjustable rate mortgage, thinking that you're going to be able to refinance it later, because no one knows what the future is going to look like. Just like if you were in 2018, 2019, and someone asked you what the next 5 years would look like, you would probably be wrong, right? Almost everybody would be. So how can one say that we're going to go back to a 4% or 5% mortgage rates? I don't think that's very likely going to happen here. So look at what rates are now. For the average American that has average credit, which is a 698 credit score, which I personally think the average is going to be going down dramatically due to what's going on right now. With student loans being due in October 1st, just a few days ago, and you're stepping into holiday spending season, people are going to be putting more and more and more on a credit card. Come January, we're going to start seeing more and more and more defaults. And so as that happens, one late payment can drop your score 180 points. On average, it's between 80 and 100 points. So I think the national average is going to be going down. But 8.64%, 30-year fixed for the average. That is absolutely crazy. If you have great credit, 780 and above, 7.9, you're still almost 8% for the perfect borrower. So I put out a video 4 months ago saying we're headed at 9% mortgage rates. In the comment section, a lot of people are saying, oh, fear monger, he's selling fear. We're basically headed there for the average American right now, right? 8.64%. And with today's job numbers, it looks like this is going to happen. We are headed to 9% mortgage rates 4 months ago. This is what's going to happen. But I think actually we could probably go to 10%, to be honest. I think we can go to 10%. Jamie Dimon said that 7% Fed's funds rate is what he is anticipating, 7%, right? He came out and he said that 4 days ago? 4 days ago, saying 7%. So to put that into context, Fed funds rate was 3.25% a year ago. And interest rates a year ago were 5.34%. Now they're over 7, right? So we gained more than 2 points on mortgages, right? 200 basis points. So when you start to look at this, you can do the math simply. We gained basically 1 point or 2.25, right? from the Fed's funds rate over a year ago, and we increased the interest rates from 5.34% to 7%, right? So if you just do the simple math, we're going 9%, 9.5% at a minimum, if Jamie Dimon is right. But he made this prediction, and then today the job numbers came out. So I think that he probably has better information than the average person, and that is likely where we're going to be headed. But how can the commercial real estate market hold on to this? Here's what I mean by that. If you're not in commercial real estate, you don't understand real estate, here's a really easy way to look at it. I'm going to simplify it. So let's say last year you were to buy $1 million property, like a 5-unit building in some type of city in America, right? That's kind of common. A 5-unit building, $1 million, right? It's a 5% return, meaning if you paid all cash, you get 5% return. So 80 grand a year gross income. You have 30% expenses, repairs, evictions, any type of expenses associated, and then you have 5% vacancy rate. So that would look like $53,000 a year, right? Annual net income. Well, at today's mortgage rates, at 8%, where a lot of these investors get to refinance the next year or so, if rates don't move from here, you're basically around 8%. That means that your monthly payment would be $6,125, right? $6,125, meaning the annual payment would be $73,500. How are you going to pay $73,500 when you're only bringing in $53,200? You're basically losing 20 grand. And so when you go back to your lender and say, hey, I need a new loan, they're going to say, okay, well, how much are you bringing in? Well, I'm bringing in $53,000. Okay, great. So you want a loan for $20,000 more per year than what you're bringing in. Well, yeah, no, you're not going to get the loan, right? You're going to have to bring more money to the table. They're going to want to see that you have equity in the deal. So they might want you to bring, on this $1 million deal, they might want you to bring another 200 grand, another 300 grand, right? So what are people going to do? They're going to look at the money they have in the bank. They're going to look at the economy. They're going to look to their investors, see if everyone wants to put up more money. Most people are not going to want to. And so what's going to happen? Keys go back to the bank. That's what's likely going to happen. And this is happening everywhere. And many deals, believe it or not, they're not at 5 caps like this. They're in LA, they're San Francisco, they're in New York City, they're in South Florida with people buying 4 caps. These people are going to be in very, very big trouble, many of them, that have to refinance into this type of environment. It's going to be an absolute bloodbath. I mean, you have $1.5 trillion that has to get refinanced by the end of next year. To put that into context, the entire commercial real estate market in America, if you were to add up every single building in the country, it's $20 trillion. So $1.5 trillion has to get refinanced by the end of next year. How can there not be devastation coming to the commercial real estate market? How can there not be devastation coming to the economy? On top of all of this, see, $20 trillion commercial real estate market, that's how much it's worth. On top of all of this, you're already starting to see layoffs. They're already up 200%, right? Layoffs are already starting to pick up, and we have U.S. companies barreling towards $1.8 trillion in corporate debt. U.S. firms are barreling towards a giant wall of corporate debt that's about to mature over the next few years. There's $1.8 trillion of corporate debt maturing over the next 2 years. Goldman Sachs estimates firms could be slammed with higher debt servicing costs. As interest rates stay elevated, that could eat into corporate revenue and weigh on the job market. But they're not factoring this in. They're just going to keep likely increasing interest rates in the short term. And then all at one time, you're going to have regional banks in trouble. You're going to have commercial real estate in trouble. You're going to have the job market in trouble with this corporate debt situation here. You're going to have all of these changes hit likely at one time, which I think could really push a wave of distress on this market, this economy, like we've never seen before. The investment bank estimates $790 billion of corporate debt set to mature next year, following by $1.07 trillion of maturing debt the following year in 2025. That amounts to $1.8 trillion of debt reaching maturity within the next 2 years, in addition to another $230 billion that will reach maturity by the end of this year. We're walking into no soft landing. We're walking in to a massive investing opportunity. This is the time you want to have everything in line. You want to have everything in line. You want to save money. You want to get out of high interest rate consumer debt, credit card debt. You want to put yourself in a strong position. Because I'm telling you, not many people are. Not many people are in a strong position, because the last couple of years, the whole conversation about commercial real estate and Airbnb and all of these different, get rich quick things was that we're never going down. This is a straight rocket ship to the moon and everyone's going to get rich. When has that ever happened? When you have the smartest people in the world selling smartest people in the world, these top CEOs, all dumping their bags in late 2021 and continue to dump their bags. You had all the big names. You had Bezos. You have Tim Cook just unloaded shares. You had Warren Buffett dumping $13 billion just a couple days ago. You have Elon Musk. You had Zuckerberg selling shares every single day in 2021. Literally every single day that the market was open, he was selling shares. Look it up, Forbes. I mean, all of these things are signaling that they knew that this thing was going to start to come down. And when you're looking at this, what do you want to be in? What position do you want to be in? The same position that they're wanting to be in. They're going to want to have mountains of cash when the entire economy starts to get really hit. So they can step in and buy infrastructure, they can step in and invest, they can step in and make significant moves. And they can step in and restructure their companies, and they can do so at a completely different place. So we're walking into something really interesting here, and all the while we're continuing to eat into our natural, or our reserves, right? Our petroleum reserves. We're starting to eat into these reserves. We've been doing so for the last year or so, and we're continuing to reduce our dependence on oil, meaning inflation is going to continue ramping up, and so will interest rates. It's a bloodbath in the making. What do you think about this situation? Where do you see this going? Do you think we're walking into a soft landing, or do you think we're walking into the greatest economic rug pull of all time? Drop below, have a conversation about this. And if you want to fix your credit, you want to position yourself for the greatest wealth transfer of all time, we'd love to help you. Love to give you a free strategy session at GreatCreditFast.com. Don't ignore your credit. If you have big goals for 2024 and 2025, you want to make some big moves, if you have bad credit, lenders are not going to want to lend to you. Point blank. If you look at 2008, 2009, 2010, that's exactly what happened. They tightened up lending on high risk and average borrowers. So if you have great credit, it's a big asset. If you need help, we'd love to help you. GreatCreditFast.com. I'll catch you guys in the next video.